On the 23rd of October, we announced our new net asset value. The net asset value is 115.3 pence per share, which is an increase of 1% from the number reported at the 30th of June. This meant the NAV total return for the quarter was 2.2%, and the NAV total return for the year ended 30th of September, the company's financial year, was 8.9%. The value of the property portfolio also increased during the period. It's now £333.9 million, which is an increase of 0.8% over the quarter. The increases in NAV and also the property valuations were driven by asset management initiatives which we have executed over the quarter. During the quarter, we completed a lease restructure at our office property in Bath, Midland Bridge House. Our tenant there had a lease which was due to expire in March 2023, but we extended that so it now expires in March 2029. This is a good result for both the tenant and the company. This lease restructure follows on from the rent review which we successfully completed in March this year, where we saw the rental grow by 11.5%. Since we acquired the asset in 2015, due to the rent review increase and this lease restructure, the value has increased by 49%. During the quarter, the lease restructure with Watemans at our office property in St Philip's Point in Birmingham became effective as at the 1st of August 2018. As a result of that, there was a further increase in the valuation of that property. For the 6 months to the 30th of September, the valuation of St Philip's Point has increased by 11.8%. There is still good demand for UK real estate from a number of different investors. However, the three main subsectors, office, industrial and retail, are moving in different directions driven by different factors. The good supply-demand equation in offices and the prospects for rental growth have seen yields remain resilient, and industrial yields have tightened further, albeit I think they now look expensive relative to some of the other sectors. We think that retail parks, with the right planning consents, let off affordable rents will continue to be in demand, and indeed across our portfolio we're speaking to a number of tenants on lease re-gears and their interests in some of our vacant units. In retail, the high street and shopping centre markets are challenging. There's going to be a likely fall in values for all but the best assets in that sector. There is more opportunity in the retail warehouse space as yields do look more attractive relative to the other asset classes. This sector hasn't been immune to the tenant failure that's been reported in the press this year, but a number of those vacant units are being filled by new and existing tenants who are looking to improve their real estate assets. Retail parks, which trade well, have got flexible planning consents and are let off affordable rents, will be more resilient. Some vacancies are appearing, but what we're seeing within our portfolio is these are being backfilled by new and existing tenants. We think our retail warehouse portfolio has a number of defensive qualities and is well placed to deal with the challenges that the market is currently facing. The implications of Brexit remain one of the largest unknowns at the moment. Whether or not there's a hard Brexit, the property market is going to be impacted in some way, but there is no consensus view as to what is going to happen. As we saw in 2016 after the EU referendum on Brexit, there was a pause in market activity as investors waited to see what was going to happen. Our continued progression in NAV illustrates that our hands-on and intensive approach to asset management is working. With Brexit on the horizon, there are going to be challenges, but we think with our portfolio, which has a number of defensive qualities, robust income, and the opportunity to improve that income, I think we're well placed to deal with any challenges, but also capitalise on any opportunities which might appear.